In today's video, we will discuss about one of the most popular Flexi Cap fund, that is Parag Parikh Flexicap fund, and check its performance using real data. And by the end of the video, we shall be able to decide whether to continue our investment in this fund or should exit the fund now. As SEBI has not made any changes in the current limit of $7 billion for mutual fund house for investment in overseas equity. So please watch the video till the end. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. To start with, we all know that Parag Parikh Flexicap fund has been one of the star performers in its category, that is Flexicap category. Here we will be taking in consideration data of direct plans only. Firstly, let's look at the basic details like AUM, that is total asset under management, which is around 24,600 crores, which is on a higher side for a Flexicap fund, while the expense ratio is 0.77%. That is also a little bit on a higher side as compared to other schemes. The benchmark index, that is the reference against which the scheme is compared, is Nifty 500. The portfolio turnover of this scheme is 17.9% and has always been low in the earlier years also as compared to its category average. The main reason of this low portfolio turnover is the investment style of the fund, as it follows buy and hold strategy, that is growth style of investment. Now let's look at the sector-wise allocation. From the table, it is very clear that the fund is heavily invested in finance, services and technology. Finance and technology being a core sector and services being an evergreen sector, and quite a good performing large and mid-sized companies form a part of this sector, and when compared to its benchmark, its allocation in service sector is on a higher side. This can sometimes lead to performance issues when the sector does not perform well. Here I would like to add that the fund has exposure to foreign equity in the tune of around 22%. For comparison, we are taking into consideration Indian benchmark only, whereas ideally its benchmark should have been a combination of Nifty 500 and Nasdaq 100 for a fair comparison, but unfortunately we do not have that additional benchmark. I had read a Twitter post of Mr. Sharat Chandra where he commented that Parag Parikh Flexicap fund is just a glorified asset allocator of the combination of 65% Nifty 500 and 35 Nasdaq 100, and the returns of this mimics that of Parag Parikh Flexicap fund. But here we will not go into much details of the Twitter post, and let's look at the top holdings of the fund. As evident, HDFC, Bajaj Holdings, ICICI Bank and Axis Bank are the main stocks of the financial sectors, whereas overseas stocks like Alphabet, that is Google, and Amazon are the major contributors in the service sector. Microsoft and HCL form a major part of the technology sector. Here also the stock selection looks good. On checking the portfolio allocation, it is evident that the large cap shares form around 88% of the portfolio, whereas mid cap shares form other 9%, and only negligible 2.5% is allocated to small cap stocks. Its allocation is similar to that of a large cap fund. Flexicap funds has the privilege of investing across categories without any capping, but as the fund's AUM increases, it's become more and more difficult for the fund manager to find good stocks in small and mid cap categories, and the fund's portfolio slowly turns like that of a large cap fund. This type of portfolio allocation and strategy is quite beneficial for long-term investors. Mr. Rajiv Thakkar for domestic portfolio and Mr. Ronak Onkar for foreign investment has been managing this fund since 2013, that is from the inception of the scheme, and that too very efficiently, and hope that it continues in future also. They have been joined by Mr. Raj Mehta in 2016 and Mr. Rukan Tarachand in June 2022. Here, this long-standing association of the fund manager with the same scheme is quite positive and an advantage for the scheme. Now let's see how the fund performs on risk parameters. Here, we'll compare parameters with the benchmark index and category average. First, mean returns, that is the average return in a year, which is 24.54, which is more than both the category average and the benchmark. Here, higher the value is better. Second, standard deviation. That is a tool to measure how much the return has deviated away from the mean return, which in this case is 19.35 and is also less than both the benchmark and the category average. Here, lower the value is better. Third, Sharpe ratio. That is a tool to measure the risk adjusted return, which is 1.09, which is more than both the benchmark and the category average. Here, higher the value is better. Fourth, beta. That is the volatility of the scheme compared to benchmark, which is 0.78, which is less than the category average. Here, lower the value is better. The fifth one, alpha. That is a tool that measures how much better the fund has performed compared to the category. Here, it is 7.93, which is far more than the category average. Here, higher the value is better. Hence, on all risk parameters, Parag Parikh Flexicap fund performs better than the benchmark index and category average, which is a positive sign for a fund. Now let's compare the trailing and rolling returns. On comparing the trailing returns for 7 years, 5 years, 3 years, it easily beats the benchmark category with a good margin. But when compared to 1 year and less, it is not able to beat its benchmark and category. From the table, it is evident that in one last year, the fund has been underperforming compared to its benchmark and category. When checking the calendar returns for last 4 years, that is 2018 to 2021, the fund has been able to beat its benchmark and category, that also with a good margin, which shows the consistency of the fund, whereas in 2016 and 2017 it had underperformed. Now let's also check the rolling returns for 5 years, 3 years, 1 year and 6 months. Here also the performance of rolling return is better than the benchmark and has been able to beat the benchmark 100% for 5 years and 3 years period. But for 1 year and 6 months, it is 81% and 71% respectively during the returns period, which also indicates that a fund performance has not been good in a shorter period, but in longer period, it is able to outperform. As seen earlier, the fund has around 26 stocks in its portfolio, and with such concentrated portfolio, underperformance over a shorter time horizon is quite likely, as weightage of individual stocks is high, and underperformance of 1 or 2 stocks can impact the overall performance, and investors should accept such underperformance in a short term. Now let's look the upside and downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here the value is 95, which indicates that the fund underperformed 5% less than the index during the rise period. Here higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here the value is 64, which indicates that the fund declined only 64% as compared to the index during this fall period. Here lower the value is better. The upside ratio has been less than 100, which is not a good sign, but with a better downside ratio, it tries to compensate for the loss of the upside ratio. So considering both the parameters, it can be safely assumed that the performance is good. Now let's see the risk return graph. Here on x-axis we have standard deviation, whereas on y-axis we have total returns. It is very evident from the graph that the fund has better total returns value with lesser standard deviation as compared to the category average and the index, which indicates that the fund has been able to generate good returns with less volatility than both its category and index. Here on almost all risk parameters, Parag Parikh Flexicap fund performs better than the benchmark and the category average, which is a positive sign for a fund. It has been a general perception, and quite a few follow content creators have been emphasizing that the SEBI restrictions will have drastic effect on the performance of the fund. But as evident in the data over a period of 7 months, the foreign asset allocation has been reduced by approximately 8%, and this reduction has been due to the underperformance of the US market and also increase in the AUM of the fund. I feel that This reduction in foreign equity is in line with the expectations, and hence investors need not worry much, and it is absolutely not necessary to check and review the portfolio every month. Equity mutual fund investments are long-term investments, and checking the fund performance too often is not needed. Ideally, one should review the performance twice in a year or maximum 3 times in a year. As you have watched the video till now, it seems that the topic is of your interest. Hence, I would request you to press the like button and also subscribe to my channel to watch such interesting videos in future. So now coming to the conclusion, what should investors do? Firstly, the existing investors. If foreign equity allocation is a major criteria for investment in this fund, then wait for some more time and see whether SEBI and RBI makes any changes in its policy. And also keep a watch on the performance of the fund, as the fund has not performed well in last 1 year. The underperformance in Parag Parikh Flexicap fund is due to its portfolio and strategy. It has always adopted a buy and hold strategy, and with such type of investment strategy, marginal underperformance in short term is possible, but this underperformance gap is narrowing if you see the returns of last couple of weeks, and it can also easily bounce back with its strong and quality stocks in its portfolio. The other major reason in underperformance of the US market, which is evident from the given table, where stocks like Amazon have given negative returns of more than 35% in last 6 months. So keeping the above points in mind in its past performance, I feel still investors should not take decision to quit the fund and hold it for some more time. Second, the new investors. If foreign investment exposure is not only the deciding factor, then can start investment in this fund, as last 1 year underperformance should not be only yardstick for investment decision, and should also consider its past performance, investment strategy, and unique combination of blend of Indian and foreign equity in its portfolio. I would like to add that I have Parag Parikh Flexicap fund in my portfolio and not planning to change in near future. I will again try to review this fund after 6 to 7 months and check its performance. So stay tuned to my channel. Please subscribe to my channel if you have not done till now, and also press the like button. Do check my older videos. Click the attached cards to watch the videos. Thank you.